So preparation depends on how much background knowledge you have. So if you are starting out fresh and you have no clue, then obviously you will have to spend much more time in brushing up your basics, understanding the key terms, then understanding the methodologies, solving a lot of problems, doing it within time. So a lot of practice is required. Good evening, all. Thank you very much. Thanks for this opportunity. So I am Lieutenant Colonel Kumar Gaurav. So I served 14 years in the Indian Army. Thereafter, I took premature retirement. Thereafter, I did 1 year MBA from IIM Ahmedabad, PGPX course. And thereafter, for last 5 years, I've been working at Devise Tokyo Life Insurance. I'm working as head of financial risk as well as fraud risk there. About my overall background and upbringing, so I have been born and brought up in Jamshedpur. I did my 12th from there, and thereafter I joined National Defence Academy, where I did 3 years of training. Thereafter, 1 year at Indian Military Academy, Dehradun, and thereafter 14.5 years in almost Army. And last 5 years, what I've been doing is, so what brought me here, let me first explain that. So I always have been following financial markets and business, economics and all. So I was always interested in the field of financial services. So through IMA, I got this opportunity to work with Devise, and there I joined in the fraud risk team in the risk department of Devise Tokyo Life Insurance. And as I told earlier, since my interest was in finance and financial services and businesses and investing and risk, so I moved to financial risk thereafter. And now I have been handling both financial risk as well as fraud risk. And within financial risk, in an insurance company, if some of you are familiar, it's about market risk, credit risk, liquidity risk, ALM, which is asset liability mismatch, which is broadly to do with interest rate risk, both on the asset and the liability side. So I manage all of that. Thank you. If there are any, I hope it was a brief introduction, and if there are any questions, willing to take them on.
Yes, so it was a perfect introduction. Now we'll move on to our Q&A round. So the first question is, what is DVP risk management?
So as I told, DVP is obviously the designation which the company provide: vice president, deputy vice president, assistant vice president, and also that is a designation. And risk management is the function I am in. And as I told, within risk management, I handle financial and fraud risk. At a broad level, there is financial risk, there is operational risk, and fraud risk is part of that operational risk. So one part of the operational risk, which is fraud risk, I handle, and financial risk fully.
Yeah. So DVP is a position like a director or vice president.
Yes.
Yeah.
As I told you,
Okay.
deputy vice president.
Okay. So moving on to our second question, should one pursue CFA or FRM?
So again, it depends on one's interest and wider, rather areas of interest and what he or she wants to pursue. So many of you would have heard that Alice in Wonderland story. Where do you want to go? Which path should I take? So it depends on where you want to go. So if you don't know where you want to go, it doesn't matter which path you take. Okay, so to come more specific to that, so if you have wider interest, economics, accountancy, finance, technology, business, quantitative analysis, statistics, quant, so all of that, if you have a wider interest, then you should do CFA because it covers all of these topics. Financial risk management, FRM, is purely focused on risk. So within that, you will learn about risk, what is operational risk, what is financial risk, what is market risk, credit risk, liquidity risk, all of that. So if you're focused on only a career in risk management, then you should go toward the FRM. And however, if you're focused on wider investing career, where you can do multiple roles, even you can do risk after doing CFA. But the point is, if you have wider interest, you want to understand accountancy, economics, and other stuff. Like in FRM, there is no accountancy, there is no ethics, there is no, say, equity, fixed income, not so much in detail, limited in the scope. If you have wider interest, you want to understand them deeply, then you should go for CFA. And obviously, if you want to become a fund manager, money manager, so you should do CFA.
I was also confused between CFA and FRM, so I think I'll go with CFA because since you told that it is a much wider path. Yeah. So now question three is in the same lines. How to prepare for CFA and FRM?
So preparation depends on how much background knowledge you have. So if you are starting out fresh and you have no clue, then obviously you will have to spend much more time in brushing up your basics, understanding the key terms, then understanding the methodologies, solving a lot of problems, doing it within time. So a lot of practice is required. And if you have some background, then what you can do, you can start more on applying part of it. So the exams, the way they are conducting, they are a mix of your learning, that what you know or you don't know, and second about how will you apply them in the exam setting within the time constraint. So if you have already got good background, initially just brush up the learning part and then start practicing. If you do not have, then initial 6 months just focus on learning, reading again and again to master those concepts and then start applying them. So it depends on that. And preparation wise, both these exams you can't leave a topic. Any question can come from any topic, so you have to cover the entire syllabus fully. So there is no shortcut here. You have to do the entire syllabus and you have to practice multiple times to master it so that you can do it within the time frame in the exam. Especially in FRM. In CFA, if your concepts are good, time is not a constraint. But in FRM exam, even if your concepts are good, some numericals take 4, 5, 10 minutes also. So if you are not fast enough, you won't be able to solve in the exam. So you have to practice a lot. So the content is limited. The content is limited in FRM. However, the rigor required is more. So more intense study is required. In CFA, the width is also vast. You have to read each and every topic, right from ethics to derivatives and alternate investment. At the same time, you have to practice a lot to do well in the exam. So it's more about mastering the concept and then practicing it.
Yes, sir, I agree. I agree on this part that practice is what makes a man perfect.
Yes, so
moving on to
just to add there, without putting pen to paper, how much ever you read, it's not going to help. If you don't put the pen to paper and don't put a time constraint on yourself, you have to answer this question in 2 minutes, you are not going to clear the exam, even if you know everything.
Yes, sir. Our fourth question is how to devise a good capital market strategy.
Okay, so capital market strategy from say career point of view, business point of view, can you share what are you looking for?
So from business point of view.
So business point of view, capital market is basically, as the name suggests, it's a source of capital for businesses. So there is a debt capital market and there is a equity capital market. So companies who need debt or equity to further grow, they tap these markets. And investment banking is the one which brings the companies and the markets together. So investment bankers take the companies to the markets, both primary and secondary markets, and as I told, debt and equity. So capital market strategy should be depending on your capital needs of the business, how you look at your growth path, what kind of capital you want. So equity is a long-term capital. Debt, you can choose the tenure. And plus equity is slightly more patient capital, because once the people are invested, they wait for the company to perform and get the returns. In debt, you have to keep providing return every month, every 6 months or 12 months, whatever is part of the coupons which we say in fixed income. So it depends. So if your cash flows are good and you are confident of ability to repay, then you can tap debt markets. However, if you want a long-term capital where people trust your business model and your entrepreneurial skills or your business capabilities or the management quality, they will come and invest in you for the long term and they will wait for their rewards. So cash flows, you don't have to pay anything upfront. You can use the cash, deploy it in the business, grow it, and over time pay dividends and over time capital appreciation on the price.
Yeah. Our fifth question is what is investment due diligence?
Okay, so as I told, so for investors, as I told, investment bankers bring the companies to the market. Now, in the markets, investors are there, both institutional investors as well as retail investors. They are the ones who have to invest. Obviously, as I told, the way company has to decide whether to invest in debt or equity, first the asset allocation investors has to do. They have to decide whether I want to invest in debt or equity or real estate or any other asset class. That is the first part of this. Once you have decided that, then obviously you have to do due diligence on the specific company or the specific asset class you are going to buy. So let's stick to equities. So if you want to buy equities, now you have to understand, as I told, from investor, as I told, what is your business model? Why are you wanting to invest in that company? What is their business model? So you start with business model. That is the first thing you should know. Thereafter, what does the business do and how does it make money? So the financials of the company, how they flow, what are the raw materials, what are the finished goods, what are the processes. If it is a services company, then what is the kind of customer need they are serving, who are the clients, everything. So everything about the business. First is understanding the model, then understanding of the business, how it makes money. And this part also includes the strategy of the business. You must understand the strategy of the business, how the business plans to grow and compete in the marketplace and win in the marketplace. Finally, you have to back the winners. You are looking at backing a winning horse. So you have to first understand how are they planning to win, and then you assess the quality of the management and their capability to deliver that growth or run the business and deliver the returns. Because finally you are investing for the returns. So business model, then how the business runs, what is the quality of the business, then quality of the management. And in all of this, finally, you have to think of the valuation and the financial side of it. What valuation you are investing at, and what is the likely valuation you are going to pay, what kind of cash flow the company is going to generate over a period of time, and then you calculate your returns based on that, whether your risk profile suits that, meets that or not. There are different companies, some give a low return, some give a high return, some are low growth, some are high growth, some pay more dividend, some pay less dividend. So you as an investor have to decide what is your need, and does your need align with the company's vision, mission, strategy, and their ability to execute and deliver those returns.
Yes, sir. And on the same lines, some investing tips that you have experienced, like that you want to share with others.
Yeah, so investing, so the only way to invest is to understand the value. So there is what the investor try and do is try and get maximum value for the minimum price. So the price value gap is the starting point. So whenever you are investing in anything, you have to get more value than what investment you are making. That is the starting point. So like you will not like to start a business on your own unless you feel that whatever capital I put in, I will get more than that. Same is true for a investment also. If you are putting your money in the investments, you have to make sure that it is able to generate adequate returns, and then only you invest. So that is the starting point. You have to look at what is the price value gap, and for understanding that, you have to appreciate value. And that is why all the investors would have heard the term value investing. So investing is you have to value a business and then decide whether the current price does it provide the adequate margin of safety to earn the rate of return. So 3 terms to remember: what is the value of the business, what is the margin of safety given the current price, and is it meeting my risk return profile? Because different investors have different risk return profile. So value of the business, value of the business, then the price which you are paying, and the likely risk reward ratio given the price. Once you understand these things, and you are made sure while investing that you have adequate margin of safety, you are likely to make the return you desire.
Yes, sir. And also, should some investors pursue securities which have which have a bigger, higher risk rate? Like, because we all say that successful investing is all about taking risk. So
yeah, so true, but then risks should get rewarded. So there are certain risks in the market which get rewarded, and there are certain risks which are not rewarded. So you have to identify which risk is likely to get rewarded. Plus, you have to assess your risk profile. As I told, if you want regular cash flow, you want dividend income, then certain companies are not for you because they will not be paying any dividends in foreseeable future. But however, if you want only capital returns, then you have to look at capital returns are going to be long term. You have to make sure that you are investing in a business which is going to last that for that long term, and it is going to earn an adequate rate of return in the capital which you invest there. So that is why first is start with the objective, what I want, and then you see where the risk return reward is there. So if you are a patient investor with a long term outlook, yes, you can take a higher amount of risk because the time is on your side. However, time is on your side if the business is good. So time is a friend of a good business and enemy of a poor business. So you have to, if you have a longer time, you can take a greater risk. It's the time horizon which should decide, and your risk appetite. Obviously, if you are taking a higher risk, what does higher risk mean? It does not mean higher return. It means higher volatility of return, higher variability of return. So if you invest in a fixed income, you know you will get 5%. You invest in equity, you know the return could be 10, 20, 30 or minus 10, minus 20, minus 30. So the variability is very high. And that is what the difference between high risk means, high variability of return. So are you okay with that high variability of return? 1 year you will get minus 30, other year you will get plus 100. Like it happened in last 1 year. So that is how you have to prepare for that. And once your risk profile meets the investment criteria or the investment profile of the business, then you invest.
Yes, sir, I get it. There are some investors who just take uncalculated risk and then they have lost, and then they say that although it is a part, like you should always take risk, but then they end up losing everything. So it is all about taking calculated risk.
So you have to assess risk. That is where risk management and understanding of risk comes. You have to assess the risk. What is the risk? Is the risk the price volatility, or is the risk if business will cease to exist, or the business will earn low rate of return? These are the only three risks. Either you will lose your entire capital, or what will happen? Market will go up 20%, you will make 10%, or it will give you more than 20% than the market. So that you have to assess, and plus you have to be patient. Like in markets, returns are never linear in equity markets. So you have to be prepared for the volatility. So volatility is not risk in that sense. What is the risk? That company is unable to meet the minimum hurdle rate which you want. Say you want 10% per annum, it is earning only 5% for next 5 years, or it is going bust and you lose all your capital. These are the two risks you have to avoid: underperformance and going bust.
Yes, sir. Yes, I agree. Moving on to our next question. What are some ways in which interest rates are managed?
So interest rates, you don't manage. Interest rates, market determines. And actually speaking, central government determines. So there is no managing interest rates. What you do is you manage the interest rate risk. So the point is, what happens is you are expecting 10 rupees after 5 years, correct? Present value, when you discount based on a current interest rate, you will get say present value of say 3 rupees. Okay. Now what will happen if the interest rate goes up in the market? The value of the 3 rupee will go down. And if interest rate goes up in the market, this value of the interest rate goes down, then value of the 3 rupee will go up. So this is the risk which you have to manage. So today, if you are investing at say 6% 10-year yield, and if the yields go up, your prices are going to fall. If yields go down, your prices are going to go up. So this risk you have to manage. So the 10 rupee which you are going to get after 5 years will not be worth 10 rupee. Rather, is not worth 10 rupee if the interest rates are going to go up. The 10 rupee after 5 years, after inflation and the interest rate rise, the value of that 10 rupee will be very less. And so the change in interest rate is what is the risk which you have to manage. And as you people must be knowing, interest rate is priced by the central banks. What central bank does is sees the demand and supply of money and decides the price. So higher inflation means too much money chasing too few goods. Theoretical answer, but too much money chasing too few goods. So then if there is so much of money, what they will do? They will make the money pricier. That is raise interest rate. And that risk you have to manage. So if you are a bond holder, you will get 5 rupee for every 6 months and 100 rupee at the end of the 5 years. But if interest rate keep rising, the value of that 5 rupee and that 100 rupee after 5-10 years is going to keep going down. And that is the risk which you have to manage.
And there are some ways in which you can manage this risk.
So again, yes, one way is hedging. Second way is you buy into assets which beat inflation. So finally, why interest rate rise? Because inflation rises. So all of those who follow central bank will know. They look at two things, growth and inflation, and based on that, they price the money. So if the inflation is going to be high, your value of your fixed income product is going to be lower. So you should invest, and that is where equity comes in. You invest in assets where it is you can. So interest rate can harm equities as well, but to an extent they earn higher than in the long run. Equities earn higher than your inflation. In the fixed income, you are losing money by investing in a fixed income if there is a high inflation. While in equity, even in high inflation, they can probably give you a slightly higher return than the inflation rate. So that is one way. Other is within, if you are investing in fixed income, you hedge. You use interest rate futures and interest rate swaps to manage your future payables. Like you get into a contract today itself at a certain price, so that after 5 years with the 100 rupee you get, its value is 100 rupee today. So that way you do derivatives trade to manage the interest rate risk, either using the futures or swaps.
Yes, sir. I got that. Our next question is, what are some lessons which Indian Army teaches you?
So first thing is discipline, second thing is courage, and third thing is most importantly is the mental toughness. So you go through so much hardships and training, and they make you rough and tough so that you can survive the war and the vagaries of war. So there's a saying in army. So the more you sweat in peace, the less you bleed in war. So the more you training you do, the more tough you are, you will survive the war. And that is how, so it makes you tough, both physically and mentally. So discipline, courage, and mental toughness, I'll say. Physical courage is part of the courage part.
Yes, sir. Yes, sir. And also, I can see every person who's in Indian Army, like they have these three things. No matter what, they always firstly they speak about discipline. Always, it is discipline, then courage, and then that you have toughness. Yeah, I get it. Next question is some tips for preparing for GMAT.
Okay, so GMAT is a basic arithmetic and English test and reasoning test, basic. But the point is, anything which looks simple is not easy. So it is not that easy. It is a tough exam. And why it is tough? One is the time pressure. Second is clarity of concepts. So the time is limited, and unless your concepts are very clear, you will not be able to do justice. Plus, it is an aptitude test. So you have to develop certain aptitude. Certain aptitude you have, certain aptitude or skills you can develop. So while you're doing preparation, you have to focus on developing this aptitude. Every day you should be learning something new or some method to reduce your time. So the trick in that exam is you get limited time to answer a question, and plus after each question, if you get it wrong, it's an adaptive exam. After each question you get it wrong, you get a lower difficulty question, and if you get it right, you get a higher difficulty question. If you keep answering, you keep getting higher difficulty and your score rises. And if you get it wrong, so under time pressure, if you do 2-3 mistakes and you lose, you keep coming down the ladder in terms of difficulty, your score is going to come down. So even though you have knowledge, you may not perform well. So the trick is to learn every day how to do it fast, plus learn new tricks how to get it accurate. So focus on that. The basics part is the basic grammar, English, reasoning, and maths, basic arithmetic, geometry, algebra, and all. So the mastering the basics is not tough. What is the applying that knowledge within that time to answer those questions. So for example, if you give 3 months for preparation, first month just focus on learning the concept. Master the concept, learn all the grammar rules, learn all the rules of the how to do reading comprehension, read a lot, learn how to comprehend a paragraph, what are the key things being said there, do a critical reasoning of all the statements you read. Same way for critical reasoning, practice that critical reasoning. Most important, once you have done this basic thing, that most critical step starts thereafter. Thereafter, you have to start practicing. You have to start solving problems, and thereafter, the second month, you have to focus on accuracy. Here, you have to, even if you take more time, doesn't matter, make sure you are doing things accurately. If you are attempting 100 questions, you are getting 95 to 100 and out of that right. In the third month, you go to the time dimension. You focus on improving your time. So if you are taking 22 minutes for a question, try and reduce it to 90 seconds. Then try and reduce it to 60 seconds. That is how you improve your timing. And once you have done all these three, you will be ready for the test. And obviously, in the last few weeks, you have to give multiple mock tests, completely rehearsing the entire duration of the exam, sitting for that much time. And what happens most in GMAT exams is, even though you are good, if you are not alert for the last part of the exam, which is the last 10-15 minutes of the exam, and you do silly mistakes in 3-4 questions, your score will come down. If you want a good score, you have to stay alert till the last minute of the exam. so that you don't get any question wrong if you know it. If you don't know, that's fine. And as one more thing I would like to say, remember the word think without ink. Many people do the mistake of reading the question and then looking at the options and trying to choose the best one. That is not the approach. Read the question twice, and then try and frame answer in your mind. You should know what is the likely right answer before seeing the answer options. Answer options are there to confuse you. If you read first, it wastes time. If you read all the 5 options, you are wasting time. You should know that my answer will contain XYZ. You just scan the 5 options to find which 2 options are remaining in that XYZ. So what happens, the way they design the test is, out of those 5 options, only 2 options remain where both XYZ is there. Then you have to look at one another factor which will decide which is the right out of them. But you should be able to eliminate the other 3 which are wrong answers straight away, immediately, without seeing those options. So first read the question, then read the question again, look for the answer, what kind of answer you are looking for, then see the options. You will come to know these 2, 3 are not possible given the question. Then home on to the last 2 and then choose the best. And if you are not able to decide and time is running out, guess and move on.
Yes, sir. And I think GMAT is easy for those who do these things. Otherwise it is.
Yes. So if you do not have a method, knowledge is not a knowledge test. It's not that you mug up, you spend 1 year, you mug up the entire thing and you will do it. It's an aptitude test. You have to use your learning and apply it within that exam setting.
Yes, sir. I'm sure these tips will be helpful for our audience. Our next question is, what is the role of data analytics in risk management?
So risk is about future. That is the first thing to be understood. Second, risk is probabilistic. Future nobody knows. Nobody can say with certainty this is going to happen, that is going to happen. So one of the best definition of risk I have heard is, risk means more things can happen than will happen. So I'll repeat it. Risk means more things can happen than will happen. So we invest in the market saying I will earn 10%. There's no guarantee. So it can be 5% return, 20% return, minus 5%, minus 20%, or 0 return. So risk means more things can happen. Today you don't know what is going to happen, but you have to manage that risk. If you are investing with a horizon ki I want to invest at 10%, are you okay with a 5% or 0% or plus 15% or plus 30%? What are the scenarios which you do not want? That is what you need to manage.
Yes, sir. And what is the role of data analytics in this?
Okay, so sorry I didn't answer the second part of it. So why I brought the part ki future is unknown and the probability part, and risk is about future part. How do you analyze options? So you use data, and that is why without data analytics, if you are trying to manage risk, you are shooting in the dark. So analytics help you analyze scenarios. What likely future scenarios could be, even the scenarios which have not happened in the past. You can visualize the scenario, or you can do a reverse engineering. What is the worst outcome which I do not want? Yeah, or say what is the outcome I do not want? Then you identify scenarios in which those outcomes could happen, and then you try and avoid those scenarios. So there is one famous saying, again I don't know who said it. He tell me where I am going to die, I will not go there. Okay, so it's something like that. So if you know what the risks are and you don't want those options, then you will work towards eliminating those options. And those options will only come to you if you do data analytics. So use analytics. So data analytics, there are 2 parts. One is descriptive, other is predictive. In the descriptive analytics, basically you identify certain dimensions of the data. In predictive, you try and predict also. So these 2 ways, you can also predict what is the likely scenario which can pan out. Obviously, there is no accuracy, and that is where the risk lies. But it will give you scenarios, and it will give you outcomes in those scenarios. The outcomes which you are not desirable, you eliminate them, you avoid them. And the outcomes which you are happy with, but you want to manage them better, you will manage them as you go along, because the future will unfold over a period of time. So today, and it's a continuous journey, and that is where also data analytics comes in, where machine learning can also be used, where the model learns based on new data. So the human beings have this basic problem. Once something is set in their mind, with the new data, they are not able to reassess what is now the risk or what is now the current scenario. A machine can learn using the new data and fine-tune its model output. So that is one additional advantage of data analytics and machine learning. So data analytics helps you assess the future better, know what are the likely scenarios, what are the likely outcomes, what outcomes you do not want, you try and eliminate and avoid them. And that is how it helps you manage your risk better. If you avoid the worst outcome is going to be good.
Yes, so and also I've heard this quote that you can have data without information, but you cannot have information without data. So I think
obviously, and actually analytics takes you from information to insight. So I'll just correct it. Information is not sufficient. Analytics help you convert that information into insights.
And our last question is
just to add, the descriptive part, I said it is information. The mean of so and so data is something. That is descriptive analytics, and it tells you what is a number. It doesn't tell you anything what to do or what not to do, and it doesn't tell you any other details. Predictive tries to predict using the same data. Okay, what scenarios could pan out given XYZ assumption. So obviously that is where analytics comes in. And only knowing information is not sufficient. You need insights. Okay, mean is so and so. What is the highest? What is the lowest? How many outliers in data? What is the median and the mode? Are the data closer to the mean or away from the mean? So all of that will come from additional data points and insights. But these additional data points will give you insights. So converting information into insights is the role of data analytics.
Yes, sir, I completely agree. And our last question is, what is the ALM function?
So as I told you, talked about interest rate risk. So asset liability management. So what happens in banks and insurance companies? There are two sides of the book and two sides of the business. One is the asset side, one is the liability side. In the asset side, you have assets which you invest to pay the liabilities in the future. In banks, what happens? The assets are shorter term, in the sense, or longer term. Sorry, you give out loans to people who pay in 5-10 years home loan, for example, or 3 years, 5 years, whatever. Your assets are shorter term. Your liabilities are shorter term. In the sense, if people who have put money in the banks, they can withdraw anytime. So that liability duration is short term and the asset duration is long term. And that creates an inherent mismatch between your asset and liability side. To give you an example, if today the asset value is 100 rupees and the liability value is also 100 rupees. If interest rate changes by 1%, which is measured by duration, what happens if interest rate changes by 1%, the book which has the higher duration will change more. So for example, if the liability duration is 10 and the asset duration is 5, when the asset interest rate increases by 1%, liabilities will fall by 10, however assets will fall only by 5. It's a favorable scenario. However, opposite, if interest rate goes up, then interest rate goes down, then liability will rise more, which is 1% change in interest rate, liability will become 110 from 100. However, your assets will only become 105. So you will have a 5 rupee loss if interest rates fall. So that is the risk which needs to be managed. You have to make sure that at each point in time, broadly, 100 rupee of assets equals 100 rupee of liability. The challenge here is the market interest rate keeps changing. So the liability book changes differently and asset book changes differently, which is the interest rate risk. And that is where I brought the point about derivatives. If you use interest rate derivatives to match the duration of the portfolio, this is called portfolio immunization. You match the duration of assets and liabilities, so that if interest rate, whether it rises by 1% or it falls by 1%, your assets and liabilities move together. 100 becomes 105 both on the asset side and liability side. Same way, 95 on both on the asset side and liability side. So you are matched at each point in time.
Yes, sir. And thank you for being here. Thank you for this wonderful session. I'm sure our audience enjoyed this and they will benefit from your tips and guidance. And I hope that you enjoyed the session as well.
Yeah, thanks for the opportunity. It was a great session. Thanks a lot. Thank you. All the best.
Yes, sir. Thank you.